Welcome back to Money and Banking, everyone. We're moving into Chapter 5, an extension of what we've been doing already. Our last chapter, of course, developed an understanding of interest rates. And in this chapter, we're going to be talking about the behavior of interest rates. Chapter 5 is actually divided into two sections, so you'll certainly have two narrated lecture presentations to watch regarding Chapter 5. In this chapter, we're going to examine how the overall level of nominal interest rates is determined and which factors influence their behavior. Overall, what we'd like to do is identify the factors that affect the demand for assets, draw the demand and supply curves for our bond market that we'll be looking at, and identify the equilibrium price of bonds and therefore the equilibrium associated interest rate. We'll want to be able to list and describe all of the factors that affect the equilibrium interest rate in the bond market. So we're going to want to know our two players very well and what causes them to supply and demand bonds. So we'll get very intimate with the factors that drive bond demand and the factors that drive bond supply. At the end of this, we should be able to have a pretty well-functioning running model of bond markets and interest rate determination. We want to describe the connection between bond markets and the money market in the second half of this lecture series. And we're going to be doing this through Keynes's liquidity preference theory. We'll list and describe all the factors that affect the money market and the equilibrium interest rate as determined in the money market. So again, we'll be getting to know a market well, all of the factors that affect money demand, and all of the factors that affect money supply, and of course, how to determine an equilibrium in that market. We want to identify and illustrate the effects of the interest rate changes in money growth over time. So we'll be looking at the connection between interest rates, money, prices, and we'll be able to talk a little bit about monetary policy and its impact on interest rates. So essentially, we'll be building two different markets as our theory of interest rate determination. One, the bond market, and two, the money market. We're going to be thinking about asset demand. Economic agents hold a variety of different assets. What are the primary assets that you hold? Well, an asset is anything that can be owned or has value. Some of the important determinants of asset demand might be wealth. These are the total resources owned by the individual, including all assets. As your wealth grows and grows and grows, you're unlikely to be keeping that wealth in liquid money form, and so your demand for assets is likely to increase as you try to find a way to store that wealth at positive real interest rates. The expected return on the assets will also influence the demand for assets. The return expected over the next period on one asset relative to alternative assets. So here we're going to be thinking that the individual has a wealth portfolio choice and they could purchase one asset or some other asset. So your demand for any particular asset will depend upon its characteristics relative to your other choices. If one asset has a higher expected rate of return than the other asset, well, then you can see you're likely to put your demand for assets in that category. Now, we might see that the rate of return on a particular asset A increases and the rate of return on asset B stays the same. And I think all of you would think, well, yes, of course, I'm gonna buy more of A. But that spread, that relative expected return, could happen because A rose in expected return, or it could happen because B fell in expected return. So when we're thinking about expected return in this portfolio choice of asset demand, keep in mind that all of these factors really are weighted relative to other assets that we could possibly be buying. And that's certainly true of our third determinant of asset demand, risk, and our fourth, liquidity as well. Risk, the degree of uncertainty that is associated with the return, right? Is this entity going to default? Are they going to miss payments? So on and so forth, right? This is a downside of asset demand. Liquidity. Liquidity is the ease at which we can convert assets into liquid money and then make them useful, of course, for purchases. And so liquidity is a good thing. It's an attractive thing. Liquidity, the ease and speed at which an asset can be turned into cash relative to other assets. The more liquid an asset, the more attractive it will be. So there are a lot of choices about these characteristics that need to be assessed when an individual is determining their demand for any particular. We've tried to frame this as sort of a theory of portfolio choice. And one of the ways that we can make this a little bit easier to understand is to make it less complicated. And so what we would do, of course, is hold everything else constant as we make the analysis. We'll hold things like the inflation rate constant. We'll hold the return of other assets and the liquidity and the risk characteristics of other assets constant as we analyze these changes in the theory of portfolio choice. Now, once we've done that, I think each of these 4 bullet points is really self-evident. It sort of makes sense to determine how attractive a particular asset is relative to the universe of other assets once the characteristics of those other assets are assumed to be held constant. So, number 1, the quantity demanded of an asset is positively related to wealth. As you become more wealthy, you need financial assets to park that wealth in. You're going to increase your demand for assets, right? The quantity demanded of an asset is positively related to its expected return relative to other assets, right? Asset A looks more attractive than asset B in terms of rates of return. You're going to purchase more A. All of this is very, I think, intuitive. The quantity demanded of an asset is negatively related to the risk of its returns relative to alternative assets. So as the stock, or as the company A starts to deteriorate in its finances and it starts to look like it may not be paying its coupon payments, the risk increases and you reduce your holdings of A, obviously transferring them into some other bond or some other asset, if you will. So risk is a negative thing. We want to turn away from it at any given price. We need to be compensated to hold additional risk, right? And that compensation would come in the form of higher interest rates associated with higher risk, right? So you see the risk increase, bond demand drops off, right? This pushes prices down and interest rates that need to be paid by bond sellers up to compensate for risk, right? Number 4, the quantity demanded of an asset is positively related to its liquidity relative to other assets. Liquidity is, again, an attractive feature of an asset. It's the ease at which we can turn it into cash and use that wealth in terms of purchasing power. So as liquidity increases, we're going to increase our demand for that asset as well. I think these things are intuitive to you, but it's important that we lay them out piece by piece so that we have a firm understanding of what's going to be impacting asset demand versus all the other things that you might think about that are maybe irrelevant. So here we've just got a summary table. This is the kind of expected response of bond demand, right, to changes in these characteristics. Wealth increases, you see an increase in demand. Expected return relative to other assets increases, we see an increase in the quantity demanded, right? Risk relative to other assets goes up, well, we're going to be reducing our demand for this particular asset. Liquidity relative to other assets increases, the asset's more attractive, and bond demand increases. We're going to have both supply and demand in our bond market, just like in all the other markets that you studied in economics. We're, of course, going to have supply, we're going to have demand, we're going to have the quantity exchanged on the x-axis, and on the y-axis, we're going to have some kind of price of whatever it is we're exchanging, right? So we'll have an upward sloping supply curve, as in all of your other markets. We'll have a downward sloping demand curve, as in all your other markets, and we'll start looking for equilibriums, right? So we've been talking about demand for assets, and we want to note that at lower bond prices, and you'll remember from our last chapter that bond prices and interest rates are negatively related, right? They move in the opposite directions. So at lower bond prices, i.e. higher interest rates, right? Everything else held constant, ceteris paribus, the quantity demanded of bonds is higher. And keep this in mind, this is the quantity demanded of bonds. We'll make sure we know what that means in just a moment when we have a diagram up. This is an inverse relationship. Now, it sort of makes sense, right? You see higher interest rates. This is a higher reward for saving, and saving takes place in the form of purchasing bonds. So as there's a higher reward for saving through higher interest rates, people demand more bonds. And we we call that, and this terminology is important, a higher quantity demanded of bonds, right? Now, the opposite is true as well. At lower bond prices, this is associated with higher interest rates. Everything else held constant, ceteris paribus, the quantity supplied of bonds is going to be lower. So there is a positive relationship between low bond prices and the quantity supplied of bonds. Remember, those entities supplying bonds are borrowing money. So as you see lower bond prices, this of course implies higher interest rates. This is a higher cost of borrowing. And as the cost of borrowing increases, borrowers of course will want to borrow smaller amounts of money. They're going to issue fewer and fewer bonds as the cost of paying those bonds back has increased. So we see movements in prices, countervailing movements in interest rates, and we see that affects, of course, our incentives of bond demand and bond supply in an opposite direction. Lower bond prices associated with a higher demand for bonds, this inverse relationship, lower bond prices associated with a lower quantity supplied of bonds. And there's a positive relationship there. So both of these entities are seeing their incentives move in opposite directions, and what we want to see is where they match up, where bond supply equals bond demand. We want to find the price of bonds and thus associated interest rate that equates those two market forces. Here we see the supply and demand for bonds. We have our bond market set up. Let's take a moment to orient ourselves. On the x-axis, we have the quantity of bonds exchanged, either supplied or demanded. On the y-axis, we have the price of bonds. Now, do note, we've also got the interest rate indicated on the y-asset because, of course, they're intimately related. So at very, very high bond prices, we expect very low interest rates. We've got a bond price of $1,000 associated with an interest rate of 0%. And as the bond price declines, say to $800, we see that the interest rate has increased up to 25%, right? So we see that relationship, that inverse relationship between bond price and interest rate clearly indicated on the y-axis. We have two blue lines. One of them is downward sloping. This is your bond demand curve. One of them is upward sloping. This is your bond supply curve, right? Let's take a point like point A. It's in the upper left-hand quadrant of your visual field, right? Point A is a point on the bond demand curve. And what that's telling us is if we had a bond price of $950 or an associated interest rate of 5.3%, we could follow that over to bond demand, essentially asking bond demanders, hey, how much would you want to buy at this market price of $950? From point A, we could drop down and we could basically kind of eyeball it and say, well, at a price of $950, bond demand is 100 units of bonds. As the price declines from $950 to $900, we move from an interest rate of 5.3% to 11.1%. And as we do that, we move from point A to point B. We're essentially riding along the line. As we ride along the line from point A to point B, we see that the quantity demanded of bonds is increased from 100 to 200. So that's the terminology of quantity demanded, right? If we're making movements along the line, such as from A to B or B to C or C to D or H to I, right? We're talking about a change in quantity demanded, assuming that we're dealing with the demand curve, and a change of quantity supplied when we're dealing with the supply curve. So that terminology will be interesting and important for us because when we're moving along the line, we know that that movement is driven by one factor only, movement in bond price and interest rate. Now, if we're dealing with a change in wealth or a change in risk, liquidity, expected return, right, then we're going to have to shift the bond demand curve around. Now, when we move along the line, we refer to it as a change in quantity demanded. When we shift the line, we refer to it as a change in demand, right? So we want to be able to keep those things separate. What factors generate a movement along the line? Well, that factor is always given to you. It's indicated to you on the y-axis. Any other factor that might influence bond demand or bond supply will be modeled as a shift in the curve. Well, let's keep an eye on this and let's work towards equilibrium. Again, let's start at a disequilibrium. And so the equilibrium is, of course, found where, X marks the spot, if you will, and we can clearly see that point C is highlighted as the point where bond demand and bond supply are equal. There's an associated equilibrium price and quantity and interest rate at point C. The equilibrium price, where quantity supply equals quantity bond demand, is at 850 and an interest rate of 17.6%. The equilibrium quantity of bonds exchanged is, of course, 300 units of bonds. But let's talk a little bit about the market forces, Adam Smith's invisible hand, that drive us to that equilibrium, sort of naturally. So let's start at a disequilibrium. For instance, let's start at a price of bonds that is too high, a price of bonds that is above equilibrium, such as 950. At a price of 950, the associated interest rate is 5.3%. This is a very low interest rate and a very high bond price, and so the quantity demanded of bonds will be quite low, coming in at point A, around 100 units of bonds, right? But the interest rate is low, which means the cost of borrowing is low, right? So at very high bond prices, right, the cost of borrowing is low, and if we follow that from 950 over to the bond supply curve at point I, we see that, bond suppliers would want to issue 500 units of bonds. So we have an excess of bonds on the market. We have excess supply, right? And we have a surplus of bonds on the market. Corporations and so on and so forth are issuing 500 units worth of bonds, but they can find nobody in the market to buy them all. There's only 100 bonds that will be sold given bond demand, and you'll have a surplus or an excess supply of 400 units of bonds, right? And so what's going to happen is bond suppliers are going to be trying to sell those off. How do they sell those off? Well, they have to encourage bond demanders to buy them. And they'll encourage bond demanders to buy them by raising the interest rate associated with the reward for buying those bonds, otherwise spoken, by dropping the cost of purchasing those bonds. And so the price will begin to fall. It'll fall from 950 to 900. As the price falls from 950 to 900, the interest rate is increased from 5.3% to 11.1%. And of course, the reward for savings has increased, and so the quantity demanded of bonds will increase from 100 to 200, right? And that'll gobble some of the excess bond supply on the market. As the interest rate increases, the cost of borrowing money or supplying bonds has also increased. And so we see a change in quantity supplied of bonds from I to H. We now have 400 units of bonds offered for sale on the market, but only 200 of them will be purchased by bond demanders. Again, we have excess supply of bonds. So long as we have a disequilibrium, whether it's excess supply or excess demand, this will force an auctioning process to take place that will trigger changes in the price of whatever it is we're dealing with. Here, we're dealing with bonds. So that excess supply of bonds will push prices even further downward, driving interest rates upward until we can clear the market. Once there is no longer an excess supply or excess demand of bonds, we've reached equilibrium, and everything else held constant. This will be a stable equilibrium until something else shocks the market. Again, reiterating, our equilibrium is found at 850. So when we see some kind of disequilibrium, it's going to trigger price changes and associated changes in the interest rate that rearranges incentives of both bond demanders and bond suppliers, driving them to get in line with each other's interests, if you will, right? Now, we could do just the opposite analysis for a bond market that was in a state of shortage or excess demand, such as at a price of 750. You can see at a price of 750, interest rates are very high, so bond supply is quite low at 100 units at point F. But the very, very high interest rate is encouraging tremendous amount of savings, and that's going to happen in the form of purchasing bonds. And so we see 500 units demanded at point E, right? There's simply not enough bonds to meet the demand for bonds, and people will start bidding up bonds, right? They start bidding up the price of bonds. As they do so, interest rates fall. We move along the quantity demanded and quantity supplied curves as we move from F to G to C in the case of bond quantity supply, and E to D to C in the case of quantity demanded of bonds. Now, that whole sort of articulation of movement towards equilibrium that we've just talked talked about is, of course, something that you have seen many, many, many times in doing economics, right? But the only different thing here is that we've got not only the price of bonds, but the interest rate. Keep in mind it's inversely related to bonds on the y-axis. We're also dealing with a few different shift factors, such as wealth, expected return, risk, and, of course, liquidity. And we want to be able to be sure that we can analyze changes in this market given some shock to our ceteris paribus conditions, if you will. This slide is a reiteration of the analysis that we have just gone through. Let's read through it just as a matter of letting it sink into your processor. Market equilibrium. Well, this occurs when the amount that people are willing to buy, demand, equals the amount that people are willing to sell, supply, at a given price. When bond demand equals bond supply, this defines our equilibrium, or market clearing price and quantity. As we have our equilibrium price, we have an associated equilibrium interest rate. When we see excess bond demand, well, price is going to be bid up and the interest rate will fall, changing both bond demand and bond supply. When bond demand is less than bond supply, when there's a surplus or excess supply of bonds on the market, the prices will fall, the interest rate will rise, and this rearranges incentives that change both quantity demanded and quantity supplied of bonds until, again, we reach the equilibrium. So this should be a topic that I think is fairly easy for you to absorb. Once we know the basics of how the invisible hand or the market itself drives us towards equilibrium, let's look at what might shock the market out of that equilibrium and look at how the market restores equilibrium so that we can see how maybe a change in wealth or a change in risk might impact the equilibrium interest rate. If you'll recall, we had several factors that might shift bond demand, right, or impact bond demand. Now, after looking at bond demand in our market, we can see that these factors are going to cause the curve to shift around. So we want to memorize these, be very comfortable with them. Keep in mind that these factors, many of them play out relative to other assets, right? So changes in the characteristics of the asset in the market that we are studying could cause these shifts, but also changes in the alternative market, whatever you're looking at in terms of should I buy treasuries or should I buy municipal securities or corporate bonds, right? Changes in those other markets would affect relative, expected returns or relative risk and liquidity, right? And we'll get into that in more detail as we move forward, right? Certainly in your homework. So what are the things that cause shifts in bond demand? You know them already, basically. Wealth. In an economic expansion of growing wealth, the demand for bonds is going to shift to the right, a higher appetite for bonds. Expected returns. Higher expected interest rates in the future lower the expected return for long-term bonds, shifting the demand curve to the left, right? So here we're thinking about expected returns, right? So a higher expected interest rate in the future, what's that going to do? Well, you remember, higher interest rates in the future mean lower bond prices in the future, which mean capital losses for bondholders if you're holding these long-term bonds. We learned in the last lecture, right, that a given change in the interest rate will disproportionately affect the prices of long-term bonds. Shorter-term bonds won't necessarily be impacted as large by a change in the interest rate as will long-term bonds. And so you're expecting higher interest rates in the future. This is going to reduce the expected return of long-term bonds relative to other assets, such as short-term bonds. Why? Because you're going to be getting a higher capital loss on those long-term bonds. And that's going to shift the demand curve for bonds to the left. Expected inflation. Now, keep in mind, we talked about expected inflation when we talked about the relationship between inflation and the interest rate in the last chapter. We also talked a little bit about expected inflation when we were deriving for you the Fisher equation, right? Okay, well, inflation does what? Inflation erodes the value of money. It erodes the value of wealth. Inflation, for a given nominal interest rate, is going to reduce the real interest rate that you're earning on your assets, right? So an increase in expected inflation, say of 2 or 3%, with everything else held constant, that's going to lower your expected real return by 2-3%. And so, as we would expect, a lower expected rate of return will cause a reduction in demand for assets. So we're seeing Our shift factor, lower expected rate of return, motivated by, in this case, expected future inflation. Risk. An increase in the riskiness of a bond, well, this risk is a bad thing. You want to be compensated for it in terms of higher, interest rates, if you will. So everything else held constant, an increase in risk without a compensating increase in return is going to cause you to reduce your demand for the assets, shifting bond demand to the left. Liquidity. Liquidity is a positive aspect. An increase in liquidity of bonds results in the demand curve shifting right. So we want to make sure that we're comfortable with these concepts, comfortable with the direction that the demand curve shifts. Various homework assignments or what have you may have you, being told there's an increase in risk in this market. Analyze changes in the equilibrium. So you'll run through these exercises, and I think you'll get through them very quickly and become very comfortable with them, as this kind of market analysis is just very typical with what you do, on an ordinary basis in really any of your economics classes. Here we have a diagram that is, essentially showing you what a shift in a curve looks like, right? We start off at point A or point B or point C or point D. We could be at any of these points, right? But a change in something like liquidity, would mean that for any quantity of bonds that you were initially demanding, they are now more attractive, right, and worth more to you, and so you increase your demand for them. And so the curve shifts to the right. Now, honestly, you can think of the curve shifting up or shifting to the right. There's logic, to motivate each of those, sort of ways of thinking about it. Just keep in mind that you need to be consistent with that. So here we see a bond demand curve shifting up or shifting to the right. They are equivalent, if you will. If you need it, here's a short summary of what causes shifts in the demand for bonds. The change in the variable is the variable is in the first column. The change that we see in the variable is in the second column. And then the impact in terms of the direction that the demand curve shifts is, of course, in the third column. You also have a very handy kind of visual reference there. And, screenshotting this or writing this down or memorizing it or what have you may just help you in future endeavors to keep things straight. So we've looked at demand for bonds, what causes changes in quantity demanded, again, prices and interest rate changes, and then what causes changes in demand, right? And we've got our factors listed here. Let's turn to bond supply, and once we fully understand that, we can start running some market dynamics. Shifts in the supply for bonds. We already went over why we have a bond supply curve that's upward sloping, right? It's the cost of borrowing, And as the cost of borrowing rises, i.e. very low bond prices, the quantity supplied of bonds is quite low. As bond prices rise, interest rates decline, and the cost of borrowing declines as well, facilitating more borrowing for investment. But let's talk about the shifts of bonds. If we remember, bond supply is business entities, essentially, right, or individuals who are wishing to borrow money for some kind of productive endeavor. So it's going to be related to, investment, if you will, right? So these are firms that are issuing bonds. I can't issue bonds, but firms can issue bonds. So can governments, and we'll talk about that in a little bit as well, right? But shifts in bond supply are going to have to deal with the concerns of firms, right? So if firms are expecting an economic expansion or higher expected profitability in one of their investment opportunities, right? Well, then they're going to want to borrow more money to take advantage of that higher profitability, right? And so they're going to issue more bonds to do so, and the supply curve of bonds is going to shift out to the right, increasing their demand for savings, increasing their ability to invest in profitable future opportunities. Expected inflation, if you remember the Fisher equation, right? Inflation eats away at the real interest rate. And so here you're borrowing money. And so what you have to pay back is determined by the real interest rate. As inflation increases, it reduces the real amount that you have to pay back, right? It cheapens your loans in real terms. You might be still paying a 3% nominal interest rate, right? But if inflation goes from 1 to 2%, your real interest rate that you have to pay goes from 2 to 1%. And so rising inflation cheapens the cost of borrowing for any fixed interest rate. And that cheaper cost of borrowing, cheaper real cost of borrowing, is going to, of course, increase the appetite for borrowing. So higher expected inflation is going to shift the bond curve to the right. Now, we've been talking with the first two factors, expected profitability and expected inflation, as being factors that would concern businesses, if you will, the cost of borrowing and the reward for borrowing. Expected profitability is the reward for borrowing, right? And what you have to pay out in real interest is the cost of borrowing. But as we mentioned, there are other players that might be seeking to demand public savings, or private savings here, right? It's not just corporations that are looking to borrow your savings and invest them in profitable opportunities, but also governments, right, will come in and demand private savings in order to finance their spending as well. So when governments finance their spending through issuing, bonds, what's happening here is they must be increasing the budget deficit. So G over T, government spending over taxes. As they increase the government budget deficit, well, they're going to be entering into the market to secure savings in order to finance their debt, right? And so on top of the existing corporate demand or business demand for savings, you will see an additional demand for savings of governments, right? So how does this work out, right? Corporations are issuing bonds, supplying bonds in order to acquire your savings. And then governments, if they're running deficits, also enter the market and start to sell bonds alongside of corporations, right, in order to secure your savings as well. So as the government budget deficit increases, you'll see the supply curve of bonds shift to the right as yet another entity enters the market supplying bonds in order to secure. Here we have a nice reduced summary table for the shifts in bond supply, profitability changes causing an increase in supply, expected inflation causing an increase in supply, and of course, governments entering the market to sell bonds as well creates an increase in supply. If you need it, of course, here is a diagram that shows what a shift in a supply curve would look like. Suppose that we are operating at point H, and as we follow point H down to the x-axis, we determine the quantity of bonds that are associated with being sold. If all of a sudden the government enters the market selling their treasuries as well, then we see the curve shift to point H, and this is true, of course, at any point along either of these two curves. So we'll be able to shift around supply and demand for a given shock that we're asked to analyze, and then look at how market dynamics will return us to a different bond price or different interest rate in equilibrium. In fact, let's do that right now, and we'll do it with the response to expected inflation. Now, when we're talking about responses to changes of inflation, usually what we're talking about in macroeconomics is the long run, right? And so there will be some theoretical implications of moving from short run to long run dynamics, which we will also state here. But let's try to keep it consistent with the simple nature of what we've been doing so far. First, let's orient ourselves. What we're looking at here is a bond market, quantity of bonds on the x-axis, price of bonds on the y-axis. And we know, of course, that interest rates are essentially implied by what's happening with movements along that y-axis as well. We're going to start with a market equilibrium at our blue curves and where they cross between bond supply and bond demand. Let's start at a point like 1, right? So our initial equilibrium is 0.1, and it occurs at a price of bonds P1 and associated interest rate. The next thing you know is there is a change in inflation expectations. Now, we can start with either bond demanders or bond suppliers. It doesn't matter. They're both going to be responding to changes in expected inflation. Let's start with bond supply and make sure we have the reasoning involved here, right? So as businesses start to see expected inflation, they start to see that the real cost of borrowing has declined, right? And so, of course, they increase their bond supply. Now, keep in mind that this will be calibrated, right? If I'm expecting inflation to rise by 2%, that's going to lower my real cost of borrowing by 2%, and I'm going to factor that 2% in the shift of bond supply. Okay. Now we've got bond demand, right? These are savers, right? And when inflation increases, it lowers the expected rate of return in this market. Again, if we saw inflation by 2%, well, bond demand is going to take into account that 2% reduction in their real reward for saving, and they're going to shift their bond demand curve saying, hey, you've lowered my expected rate of return through higher inflation, and I'm cutting back on my lending. I'm cutting it back on my bond purchases. So each of those curves are going to shift relative to this 2% kind of recalibration, right? Well, let's keep it P1, right? We've seen at P1 that an increase in expected inflation has shifted bond supply out to the right and shifted bond demand into the left, opening up excess supply of bonds, which will put price pressure downwards on bonds. Bond prices will begin to fall, and as we do so, we'll start riding along the bond supply and bond demand curve towards point 2. What's happening here is we're moving to a new equilibrium at P2, right? And so that gap between P1 and P2 will be the change in the price of bonds that we exhibit. As you know, right, that falling price of bonds, right, is associated with a rise in the interest rate, right? And so these things are going to lead to a long-run condition, which is that all of the nominal variables in the economy move at the same rate. So I've got a little tagline there down in the left-hand corner. It's just a little shorthand to kind of to help you keep in mind this point, that whatever the percentage change in inflation is, well, in order to return to equilibrium in the bond market, we're going to have to see the exact same percentage change in the interest rate. And that was exemplified by our Fisher equation that we saw in the last lecture, right? So the quantity of borrowing and lending, right, the quantity of bonds bought and sold is the same at point 1 and point 2. And so the real incentives to borrow and to lend must be the same at point 1 as at point 2. What we've seen is inflation increase, and that has pushed up the nominal interest rate associated with the movement from P1 to P2 an equivalent amount. So if there was 2% inflation, we would have seen an increase in the nominal interest rate of 2% as well, leaving therefore the real interest rate constant and the real amount of borrowing and lending also constant. So the change of inflation was equal to the change in the interest rate. The percentage change in inflation was equal to the percentage change in the interest rate. Here we're seeing that changes in expected inflation are driving proportional changes in the nominal interest rate, with everything else held constant. Of course, other factors might be impacting markets, so this is an analysis in a vacuum of those other factors. Do we see that relationship play out in the data? Again, does the Fisher equation generally work well for explaining what the relationship between inflation and interest rates are? Now, again, we're assuming everything else, like Federal Reserve changes of the money supply or Federal Reserve interventions into the bond market are not taking place here. We're assuming that the other things, such as greater expected profitability or the expectation of a recession, isn't going on here, right? And so we're looking at a real-world data stream that might include all of those other shocks, and we're trying to see if our vacuum, experiment of just expected inflation and nominal interest rates, can kind of be seen in here. And I think the answer is yes, right? I mean, particularly if you're looking at certain periods of time, you see that expected inflation moves and movements in the nominal interest rate generally move in the same direction, right? And so they are correlated as the market tries to absorb and reflect expected inflation in whatever the prevailing interest rate is. And certainly some periods of time, that relationship is much closer, such as 1995 through 2000, right, before you see Federal Reserve intervention in interest rate markets because of the dot-com boom, right? But you're seeing a very strong relationship there between the nominal interest rate and expected inflation, right? You can see the gap between those, of course, would be the real interest rate. All right, well, that looks really good. Let's do another one of these examples out the lecture. The response to a business cycle. Again, we're going to start at point 1 with the blue curves, and we're going to say that the equilibrium, of course, is P1. There's associated interest rate with P1, and now we're going to get a shock to the market. We're going to try to see if we can use these market dynamics in the invisible hand to analyze or predict what a change in the nominal interest rate would be. What's the shock we're dealing with? Well, this is going to be a business cycle. What kind of business cycle? Could be a boom, could be a bust, could be a recession, could be an expansion. Here we're dealing with an expansion. We're thinking economic activity is going to increase. We're thinking GDP is going to grow. We're expecting a growth overall in the economy, right? What is this going to do? Well, primarily, it's going to increase the expected profitability of firms. And as a consequence of this, they're going to want to invest more to take advantage of this growing economy and growing demand out in the market for GDP. Consequently, they increase the supply of bonds. So the first shock here is that we see bond supply 1, the blue line, shift out to the right and become bond supply number 2. This is an expansion, or the response to an expansion of expected profitability of business, right? Now, we can already see that that's going to open up excess bond supply in the market and then consequently drive bond prices down. But the expected expansion in the economy will also affect households through the channel of wealth, right? They're expecting their wealth will grow because the economy is going to be expand and be more profitable for everyone. And so bond demand increases, although to a lesser extent than bond supply. And we move from BD1 to bond demand 2. Now, if we're looking at bond demand 2 and bond supply 2, we can see at the old price and old interest rate P1, we have excess supply in the market. In order to eliminate this excess supply, we're going to have to see bond prices decline and interest rates rise. As interest rates rise, we move along the bond demand curve. There's now a higher reward for savings, a higher reward for purchasing bonds that bear interest rate. And we see bond supply, the quantity of bond supply reduced as we move along the bond supply curve. Why? Well, the cost of borrowing to finance is increasing as bond prices fall. Eventually, we move to a new interest rate and a new bond price equilibrium at P2. The gap between P1 and P2 reflects higher interest rates during business expansions and, as you can expect, lower interest rates during business contractions. Again, let's check that out. Here we've got figure 7. This is business cycles and interest rates on 3-month Treasury bills up to 2017. Do note that the shaded areas are economic downturns, right? And so during economic downturns, we would expect expected profitability to go down. We would want bond prices to go up, and of course, interest rates would fall. In our last analysis, we did just the opposite of that. We said there's an expansion, all right, and bond prices are declining, pushing up interest rates. So let's look at periods of time, just after these recessions, and you can take a look at a couple of them. You can look at some of the more recent ones, right after 2000, 2001 with a dot-com boom. What do we see after that? Recovery and subsequent economic expansion, rising interest rates. Yeah. What do we see earlier on during the 70s? Again, falling interest rates during contractions, rising interest rates leading into expansions, and then contracting interest rates again during, sort of recessions, if you will. So this pattern is holding, and it's holding pretty well, thinking about just the bond market and interest rates being determined by private bond demand and private bond supply. Do keep in mind also in the modern era, we also have central banks intervening in bond markets, buying and selling bonds in order to achieve interest rate goals. And so what you've seen after 2008 with the Great Recession was, of course, that interest rates fell during that period of time, not only because of a shortage of demand for bonds and a shortage of expected profitability in terms of supplying bonds, but also because of central bank intervention in the market, right? Buying up a lot of bonds to shore up the economy, therefore pushing up bond prices and dropping interest rates to rock bottom levels. Even though the economy was starting to grow out of this deep, dark, horrible recession, right, we saw interest rates remain low. So in this case, what was happening was central banks were preventing interest rates from rising through intervention in bond markets. We'll talk about how they do that in some chapters after the midterm takes place with open market operations in the Fed taking place in Manhattan. So hopefully you've got this under your belt. Run through a few different examples. Sit down, write down a bond market, and throw something at yourself like, what if there's a change in risk, or what if there's a change in liquidity? And you get very, very comfortable with these kind of simple market analysis and simple market dynamics. You'll have several homework questions that ask you to do sort of exercises very similar to these. I think they're going to be very constructive and useful for you. And as I said, we're going to break this chapter up into 2 different sections. So the next section is going to be the Keynesian liquidity preference theory of the interest rate. And we can move on to that as soon as you're done with this, or whatever time sort of suits you. Do take time to absorb and digest this, though. I want to thank you for your time and attention. I hope that this narrated lecture series created some value for you, and we look forward to the next installment in this series. Have a lovely day.